All right, here's the deal. Mortgage rates are moving again, and experts can't even agree where they're headed. Some say they're about to drop, others warn they'll climb. That leaves homeowners like you and me stuck asking, do I refinance now or wait it out? Because here's the wild part. The difference isn't small. It could mean saving hundreds every single month, or losing out on thousands if you mistime it. I've been digging through the latest numbers and forecasts, and in the next few minutes we'll cut through the noise and figure out whether refinancing today makes sense, or if patience could actually pay off. Why refinancing matters. First, let's make this simple. Refinancing is just replacing your old mortgage with a new one, ideally at a better rate, a better term, or both. Think of it like trading in your phone plan for the same service, but at a cheaper monthly bill. Here's why it matters so much. 1. Monthly cash flow. This is what most people care about. Lower rate equals lower payment. Quick example, on a $300,000 loan at 7%, your payment is about $1,995 a month. If you refinance to 6.25%, it drops to $1,847. That's $149 saved every month. Push it to 6.0%, and it's closer to $200. Over a year, that's $2,400 you can redirect toward groceries, gas, or savings. 2. Lifetime interest. Even if your monthly payment doesn't drop by much, lowering your rate changes the total interest you'll pay. Mortgages front-load interest, meaning in the early years, most of your payment is going straight to the bank. Shaving your rate can cut tens of thousands in lifetime interest. 3. The clock. A refi can restart the 30-year countdown, but you don't have to let it. Say you've been paying for 5 years and owe around $282,000. If you refinance at 6.25% with 25 years left, your payment drops while staying on track. Or, if you keep paying your old amount, you'll shave years off your loan, sometimes nearly a decade. 4. Removing PMI/MIP. If you bought with less than 20% down, chances are you're still paying mortgage insurance. Refinancing after building equity can cancel that fee, often saving $150 to $300 a month. That's like giving yourself a small raise just for updating paperwork. 5. Loan type or term. On an ARM and worried about adjustments? Switch to fixed. Want to be debt-free sooner? A 15 or 20-year loan raises your monthly, but cuts 6 figures in interest. Have a second mortgage or HELOC. A refinance can combine everything into one steady payment. 6. Costs and break-even. Refinances aren't free. Closing costs usually run several $1,000s. The math you need, break-even months equals costs divided by monthly savings. If your costs are $4,500 and you save $150 per month, it takes 30 months to break even. Stay longer, you win. Move sooner, maybe not. 7. Financial flexibility. Lowering payments isn't just about saving money, it's about options. That extra $150 or $200 a month could build an emergency fund, pay down high-interest debt, or go into retirement without changing your lifestyle. Current mortgage rate snapshot. As of September 9, 2025, bank rate. 30-year fixed, approximately 6.7%. 15-year fixed, approximately 6.0%. ARMS, mid-5% range. Back in 2021, many homeowners locked in mortgages at 3% or less, basically free money. By late 2022 and 2023, rates spiked above 7%, even brushing 8%, the highest in 20 years. So compared to the brutal highs, today's rates look like a relief. But compared to the golden days, they still sting. Real-world snapshot on a $300,000 loan. At 7.5%, you're paying approximately $2,098 a month. At 6.7%, it's approximately $1,935. That's $163 saved monthly, or nearly $2,000 per year, just from a rate change. And if you compare a 30-year at 6.7% with a 15-year at 6.0%, the difference is stark. $1,935 versus $2,531 a month. Yes, the 15-year costs about $600 more, but you're debt-free 15 years earlier and save nearly $200,000 in interest. Bottom line, we're better off than last year, but nowhere near historic lows. The question is this the dip before another drop or the calm before another climb? Factors to consider before refinancing. Here's your personal checklist. Current versus new rate. Aim for at least 0.5 to 1% lower. Even half a point saves serious money. Break-even point. Closing costs divided by monthly savings equals months to recoup. How long you'll stay. If you'll move soon, you may never break even. Credit score. Higher scores qualify for lower rates. A jump in your credit could unlock savings. Equity. More than 20% equity could eliminate PMI. Loan term. 30 years means lower monthly but higher lifetime cost. Shorter terms flip that. Your goals, stability, lower monthly, faster payoff, or tapping equity all point to different choices. What happens if you wait? Let's flip the coin. If rates drop, refinancing later at 6% instead of 6.7% could save $193 per month, adding up to $11,500 over 5 years. If rates rise, waiting could push you back to 7.5%. That's $163 more each month, about $6,000 gone in just 3 years. If rates stay flat, you've just delayed months of potential savings. Other risks: lending standards may tighten, your credit could dip, or home values could fall, hurting eligibility. Waiting is a gamble. The reward, bigger savings. The risk, higher payments or missed opportunities. Alternatives to refinancing. What if refinancing doesn't make sense right now? You've got options. Extra principal payments. Add $150 per month, cut 4.5 years off your loan, save approximately $47,000 in interest. Bi-weekly payments, 26 half payments a year equals 13 full ones, cuts approximately 4 years, saves approximately $40,000. Cancel PMI, request removal once you hit 20% equity, saves $150 to $300 per month. Tap equity without replacing your low-rate loan. Mortgage recast. Make a big lump sum payment, re-amortize and drop monthly payments without a new loan. Budget optimization. Reshop insurance, trim subscriptions, or knock out high-interest debt. Sometimes the easiest savings aren't in your mortgage. Refinancing isn't about guessing rates. It's about your numbers, your rate, your costs, your break-even, and your timeline. If today's market lowers your payment meaningfully and you'll stay long enough to break even, it's worth exploring. If your rate's already low or you'll move soon, refinancing might not help. Waiting could save you or cost you. The only safe answer is to run the math for yourself. So here's what to do. Grab your loan statement, compare your current rate to today's averages, and run that break-even calculation. If the numbers add up, talk to a lender. If they don't, look at alternatives like extra payments, dropping PMI, or a HELOC. Bottom line, the right answer isn't refi now or wait. The right answer is whichever path saves you the most money. And now I want to hear from you. Are you planning to refinance or sit tight and wait? Drop your thoughts in the comments. Your story could help someone else. And if this breakdown gave you clarity, do me a favor. Hit like, subscribe, and turn on notifications. We've got more no-nonsense guides coming up to help you make smarter money moves.